Hello, ladies and gentlemen. My name is Daniel Abok, the founder of Kidaftari. And today I'm going to introduce my first episode of a series of um, content around accounting that I'll be releasing over the next several weeks. So today I'll be covering the concept accounting and why I say or how I perceive accounting as the process of tracking how value moves in a business. So for example, I'm going to start with an example where you have a business that has cash. Let's say they have cash and they're going to buy inventory. They're going to buy inventory. So here they're going to buy, let's say they have 1,000 shillings or 1,000 in whatever value or whatever currency, and they're going to purchase inventory worth 1,000. In this case, recording that you have used cash to buy inventory worth 1,000, you have used cash worth 1,000 to buy inventory worth 1,000. Recording both sides would be called accounting, but in my head, it's basically a value transformation. So value came from cash and ended up becoming inventory. So that for me, that's what accounting is. Basically, recording where value came from and where it ended up as. So it came from cash, basically reducing your cash by 1,000, and it ended up as inventory, basically increasing your inventory by 1,000. In this process, you say there is no loss in value, but basically a transformation in value from cash to inventory with the same value, at the same value basically. So with that, I'm going to introduce the concept balance sheet. So balance sheet. So what we are taught in school is that balance sheet is assets is equal to capital plus liabilities. Being someone who likes deriving formulas and understanding where this basis came from, it was hard for me for this to stick in my head. I didn't understand why we have such a formula or why we have assets is equal to capital plus liabilities. So this, once I started perceiving accounting as value movement or tracking of value, so this is how I perceive this from the example you had, like assets. So let's say we still have the assets on one side, or you have capital and liabilities on the other side. So we had cash. Let's say this cash. So we have cash. Not 1,000. In this case, we have to record where we got this cash from. So if this cash, as we started the business, came from the owner's pocket, worth 1,000, so this naturally will be under the capital. So the fact that we have recorded what the value that we have for the business, the value that we have for the business for operations, so we have the cash worth 1,000 for operations, and the fact that we have recorded where the value came from, so where that cash came from, that is accounting. That's the accounting, the process of tracking where the value came from as the owner's pocket, and the recording where the value now ended up as in assets for now ready for operations. So basically, the fact that we have recorded both perspectives, where the value came from and where it ended up as, That's what we call accounting, basically. Simply put, that's what we call accounting. And it was really interesting for me to find out that. And so basically, balance sheet doesn't just exist for its own sake, magically appear. The balance just doesn't magically appear. Balance is basically recording both perspectives, where the value came from and where it ended up as. So recording those perspectives is what we call balance sheet. Once I understood accounting this way, debit and credit stopped feeling like memorization, and it started feeling like a natural way of tracking how businesses operate. With that, I'm going to end this episode and hope to see you in the next one. Thank you and stay tuned.